Hello and welcome to the October eValue Market Evaluation webinar. These webinars are hosted each quarter and provide an update on what has happened in the financial markets over the last quarter and how those changes have affected the expected returns and portfolios that are updated each quarter based on the eValue asset model Insight. With me today are Mark Grimes, eValue's Product Director, and Salman Ansari, and a senior member of the eValue asset modeling team. For now, I'll hand over to Mark, who's going to provide an overview of eValue's approach to asset modeling.
Thank you, Ben. So the eValue asset model Insight is an economic scenario generator. That is, its output of the model is many thousand different paths of how the economies of the world might develop and the asset returns that would be associated with each of the major asset classes as those scenarios develop. These scenarios are then used in all of our tools to produce possible outcomes of investments in the hands of consumers, as well as to optimize portfolios for each different level of risk that a consumer might be prepared to take. eValue has been modeling investment markets since 1993, and we have over 20 years' experience of building economic scenario generators for the use of forecasting investment markets and optimizing asset allocations. The purpose of this quarterly bulletin is to provide financial advisors with independent commentary on investment markets and the background to quarterly changes in our asset allocations, so that these can be communicated on to your clients. We stick to a medium to long-term view. Our independent approach is designed to make sure that we don't get caught out by any single idea, no matter how interesting and compelling it might be, but that we instead systematically consider the range of possible outcomes. So, for example, at the moment we recognise that record low interest rates mean that future fixed income returns will be meagre at best. And actually the impact of a return to a high interest rate environment would create havoc in bonds and substantial capital losses. However, we must also consider the other possibility that falling inflation, negative interest rates in some economies, and weak productivity growth across the world could mean that rates could stay low or even actually fall further from the current very low levels that they see. And there's a chance that actually bonds may not turn out to be such a bad investment after all. So what are the key requirements for our economic scenario generator? Well, any model that we use, or any asset model that we use, must be fit for the purpose for which it's used. And this may seem like an obvious statement, but it's important to understand the purpose for which we are using the asset model and the returns that we're generating. For our purpose, we're actually considering the range of outcomes of investments in the hands of consumers to achieve their goals. So for this, actually, it's the consumer and the investor that's important. For this reason, it's important that we model inflation consistently with asset returns. Strong asset returns are of little value to an investor if at the end of the day the purchasing power is eroded by future inflation. Similarly, for many investors, their long-term goal is actually to generate income, whether they explicitly state that or not in terms of a retirement goal. And again, capital growth is of limited value to them if the income that they can use that capital growth to generate is eroded by, for example, low interest rates at the moment. So for this reason, we model both income and capital growth separately and combine them into a total return. The consumer is typically investing now, so actually the rates and yields that are available right now are important to them. And for these, as these economic conditions change, we update our model quarterly to reflect that. Investment markets and opportunities are global, so we have a global asset model which is then presented in a consistent currency, so that actually we represent all of the investment opportunities around the world that are available to investors. Finally, our model needs to reflect that investors have different time horizons. Some are investing for the short term, some are investing for the long term, but that actually assets themselves have different risks associated with different time horizons of investments. The key difference being, for example, if you look at cash, it's clearly the lowest risk asset class to hold if you're worried about fluctuations over the next month or next year. But if you're worried about what the future value is going to be in 20 years' time, actually the variation of possible returns from cash becomes much bigger, and the variation of possible returns, for example, from a fixed interest holding or a government bond holding, becomes much lower. And that change in the risk of different asset classes over time is a central facet and feature of our model. A little bit of background just on the model structure. So the basic structure of the model is to model the possible progression of economic variables over time. That's the left-hand side. And then to translate those economic variables into what that means for asset returns. In order to achieve the key requirements that we have for our economic scenario generator, our key starting point is to model real interest rates and government fixed interest, i.e. nominal interest rates. The progression of future interest rates gives expected returns on government bonds and cash, as well as inflation-linked bonds. The difference between future nominal and future real interest rates gives us an implied and consistent inflation assumption. In addition to the core interest rate models, we also have an equity dividend and growth rate model, which gives us the expected equity returns. And the expected equity returns then feed into the corporate bond model, which has both linkage to interest rates via the government bond yield curve and an element of exposure to company performance via an element of equity exposure within those returns. We also have a property rental yield and growth model, which gives expected property returns, as the portfolio that we model on those properties is a commercial property portfolio. Each of those economic variables down the left-hand side is calibrated in four major currencies: sterling, US dollar, euro, and yen. And there's an exchange rate currency model between those to express those returns from individual local markets back into the base currency of the investor. Finally, in this section, looking at how we build up the core asset model concepts. So we have a model calibration. The model calibration is all the parameters that we fit to the model based on the historic data that we have to calibrate the model. This is done annually, as well as any updates to the underlying modeling approach to reflect latest academic thinking and research. The model is based on a states-based approach. What do I mean by that? It means that we build up future scenarios, what can happen next year based on what's happened this year. And that's important for consistency, but it also is important for our quarterly updates because we start from where we find ourselves now. So, and in order to reflect where we find ourselves now, we update the starting position of the economy and the yield curves quarterly. And we publish them quarterly and update all of our implementations of tools quarterly as well. We do actually provide monthly updates for internal use, which allows us to see a direction of travel, which would also allow us to update very frequently if, for example, there were very volatile market conditions which actually change things substantially. Although over the period that we've done this, including the credit crunch and other dot-com crises, we haven't actually updated more frequently than quarterly in the past. And the result of all of that is each quarter what we get is the simulated scenarios that come out of the model, which is used across all of our implemented tools and our optimized portfolios. So I'll now hand over to my colleague Salman to talk through the changes to this quarter's calibration and the impact that they have on the expected long-term returns and portfolios.
Thank you, Mark. I'm Salman Ansari. In this part of the webinar, we will look at how the economic indicators have changed over the quarter and how these changes are reflected in our asset model insight in the form of changes to expected returns projections. As noted earlier, interest rates are the cornerstone underpinning asset price movements, so we will start with interest rates and then move on to other assets. At the beginning of the quarter, the general feeling was an anticipation from the Fed to raise interest rates in September. However, concern over a fragile economy on the back of the Chinese stock market crash at the end of August and sustained low inflation forced Janet Yellen to hold tight on interest rates. In the UK, Mark Carney of the Bank of England took a more cautious position, signaling precautions ahead of an autumn interest rate rise. The economy is still growing, albeit more slowly than before, but it is still the fastest growing economy in the Western world. Employment is strong, and wages are finally showing signs of growth. All these indicators signal an imminent rise in interest rates. However, inflation is consistently low and well below the Bank of England's target of 2%. In addition, the current account deficit is running at an all-time high. So on the back of these mixed signals, interest rates have been held at their historic lows, although there have been swings in bond yields and stock markets in recent months. This can be seen in the performance of, say, the 10-year UK government bond yields, whose yields have generally decreased over the quarter. For the UK, there has been a drop of about 50 basis points, which is about a 20% decrease over the quarter. The US 10-year yields have mirrored the trend seen for the UK, declining similarly over the quarter. Japan continues to be subdued, with its already low rates declining even further over the same period. Germany and France have also mirrored the trend seen in the UK and US, but at a lower level, with similarly declining yields over the period. Italy and Spain have also followed suit. They are no longer bucking the trend that they set during the bailouts 3 years ago, with more yields in line with the UK and the US. Greece, however, is still out there, having pulled back from the Grexit scare at the beginning of the quarter, when its 10-year yields hit 18%, to end the quarter on around 8%. The upshot of all of this is that lowering yields indicate weakening prospects for fixed income type returns. A look at the real yields shows that these are still firmly negative, and more so since the beginning of the quarter. This means that real returns continue to be hard to come by, and this lowers the prospects of index-linked bond returns over the quarter, as we shall see. Now let's have a look at equities. How have they done over the quarter? The main observation here is a general decline over the quarter, with a notable dip near the middle, corresponding to the Chinese market collapse at the end of August. We will say more about this later on in this presentation. This also produced a spike in the VIX, which again we will discuss later on. So let us start with having a look at what happened to the UK equity market. The UK equity market ended up 6% lower over the quarter, and similar results were seen for the other developed equities. The US, Eurozone, and Japanese stock markets have mirrored what happened over the same period in the UK. Notably, there is a near-perfect correlation on the downside movement during the Chinese market collapse, showing the classic correlation of equity markets during downturns. The Asia-Pacific and emerging markets have also declined, except more dramatically than the others. The stock market movements that we have shown thus far were in the local currencies. To see the effect for, say, a US dollar investor, we should look at these stock market returns in a common numeraire. So let us first have a look at what the exchange rates have done over this period. As you can see, there is little movement over the past quarter, so we don't expect to see much difference in US dollar returns for the stock markets. And this is borne out by having a look at how the 6 equity markets that we've shown thus far have performed over the quarter. Now a word or two about the Chinese market collapse. The Chinese stock market had been growing at a remarkable rate since the beginning of the year, to what some would say were artificially high levels. However, concerns were being raised about growth, so the People's Bank of China has been cutting interest rates. In fact, the latest cut was only last Friday, when the one-year benchmark was lowered to 4.35%. The Chinese government also weakened the exchange rate between the yuan and its pegging against the US dollar. All these activities, however, failed to stop the massive correction that took place on what is being called Black Monday for the Chinese markets at the end of August. As you can see from the chart, the Shanghai Composite dropped about 8.5% on the first day, which was the biggest sell-off since 2007. Stock markets around the world reacted to this collapse. The US had the biggest sell-off in 4 years, and £74 billion were wiped off the London Stock Exchange. The VIX, which tracks the equity volatility of the S&P 500, spiked over this period as global equity markets reacted with uncertainty to the news from China. But this is an ex-post indicator, so unfortunately anyone using this as a trading signal would be reacting after a big part of the market movement had already occurred. Excuse me. The main take-home from the discussion thus far is that prospects have lowered over the quarter. Outputs from our model reflect this observation in the asset returns projections. We will demonstrate these by way of tilt charts. These show the change in asset returns over the quarter at various time horizons. A movement to the right indicates an increase in risk, while a movement to the top indicates an increase in return. At the relatively short time horizon, in this case 8 years, all asset returns movements are in the bottom left quadrant, meaning that there is a reduction in risk and return over the quarter. The prospects for cash have been least worst affected. There's only a slight decrease in return for a much larger decrease in risk, making cash very favorable and definitely more favored than bonds at this time horizon. In terms of equity, for specialist equities, which is our asset to emerging markets, there is a large decrease in return for almost no change in risk. So there will be a movement away from specialist equities into developed market equities at this time horizon. If we look at the longer term, again all asset returns movements are in the bottom left quadrant, meaning that there is a reduction in risk and return over the quarter. Even though cash is again the best performer, it will not appear in portfolios at this time horizon. In terms of equities, the story is much the same. There will be a movement away from specialist equities into developed market equities at this term. In summary, let us have a look at the performance of the asset classes over the year. Overall, the expected returns for October are back where they started in January, with a dip and a rise in the middle. The notable exception is property, which has shown a decline in expected returns over the year, reflecting the strong performance of this asset class over this period. Property valuations have grown strongly this year, so future expected returns are lower. And that brings us to the end of this presentation.
Thanks, Salman and Mark. So that brings the webinar to an end. However, if you have any follow-up questions, please feel free to send those through to us at contact@eValue's.com, or alternatively, you can get more information or send your questions through our website, www.eValue's.com. But until next time, thank you for attending, and I hope you all have a good afternoon.